This is the fifth module where we're diving into why choosing syndications over the buy, rent, rehab, repeat model, or just buying little turnkey rentals like how I started from 2009 to 2015. Let's set a couple terms here. Market appreciation versus forced appreciation. Market appreciation is the price of the market goes up and we make a good amount of money. Some people call this kind of the trade winds behind your back. Of course, you always want to be investing in a good market and in good times, but you can't always predict this. From 2010 to 2021, 22, that was a great bull market. We've had economists on the podcast many times. And if you read a lot of academic books, a lot of times they'll say normal market cycles typically last anywhere from 7 to 10 years. They go up gradually and then come down a lot quicker. And this is no different than the last one we saw. So probably we'd like to say that the 2020 beyond cycle is definitely looking like a nice, good bull run. And as we all know, the earlier years are the years that early adopters who come in, who have the confidence to go in when nobody else goes in, are going to get most of the returns. So that's why it's important to empower yourself, get educated so you can think for yourself. And when I mean everybody else, obviously that was a lot of people getting involved in the game in 2021, 22, 23 at the peak of the market. But it's all been hindsight. And that's why we say you always wanted to diversify over 4 to 6 years. So that's why if you're looking at deals now, you got to just get in. The vision is to build a portfolio of dozens and dozens of deals and spread it over that long time horizon. So just in case you do invest in a year where there is a correction, you have your portfolio spanning that long time horizon. So getting back to it, market appreciation, just dumb luck, right? This is like what amateurs do. They buy things and they hope that the market goes up. And yeah, it typically does over the long haul. Now, forced appreciation. Now, this takes a lot more sophistication to do. You're actually doing things at the property. So you can see a picture of one of our, Class C assets that we picked up. I think this was back in 2018. We only held it for a couple, 2.5 years, I believe, and doubled investors' money on this one. You can see the renovations. Take a look at the kitchen. The kitchens are always the telltale. You can see the new flooring, new appliances, new paint jobs. Sometimes the cabinets are just resurfaced, repainted, and new hardware. Very rarely, now you're getting into the heavier value add, but this is considered cosmetic renovation, anywhere from $5,000 to $15,000 of renovation per unit. Of course, there's other things that get done. You can see the paint job on the outside of the clubhouse. Obviously, the clubhouse got revamped and jazzed up a lot, but that is example of getting your hands dirty, doing construction, and force appreciating the asset. And this is what I like. That you're taking faith in your own hands. You're not just relying on luck to make money. Now, obviously, when you get both of these right, this is where you greatly overachieve performance. And we like to set before where we look into the future and predict where the market's going to be at and predict a softer market. In reality, we want to be pessimistic. We don't want to count for market appreciation. But when I was picking up little rental properties from 2009 to 2015, I was just putting 30-year loans on it. And the great strategy, I think, for getting started. That said, that was a long time ago. And this strategy is called, crudely, the buy, hope, and pray model. When you are doing this type of strategy, you're putting a loan on it, you're ideally cash flowing, but there's nothing you're doing to force appreciate that asset. There's no value add. Now we're getting more involved in private equity deals, buying a business and doing various things to value add that business, changing out employees, adding systems and processes, adding new product lines to increase revenue, and doing various other things to lower expenses. No different in force appreciating a business to then sell it for more. At the end of the day, there's a saying out there that I've heard: wealth comes to those who create value. And in this case, the value is better living conditions for the tenants who in turn pay more rent. I never really liked the idea of businesses where they buy and sell things on Amazon and just play this arbitrage game. Yeah, I get it. They're helping out with the supply chain and adding value there, but really they're not doing anything to the physical product. Not only can their business plan get caught there if there is a correction, but in holistically creating wealth, when you jump into these types of projects, you can feel good that product is getting improved. And it also, especially when you're talking real estate, it improves regular people's lives. So let's dig in a little bit more into the numbers. This is the magic part of investing. There's a laundry list of different things you could do to force appreciate the asset. A lot of times, the property management will be a little bit dysfunctional. This is why when new investors look up the property on apartments.com or Yelp and see it's 1 or 2 stars, that's exactly why we want to buy it, because we want to improve the service and the tenant base. So when you see that type of stuff, and this is why when we do physical due diligence, we want to see broken handrails here or there. We want to see paint chipping and dysfunctional things, because these are things that we can improve. But just go with me on the numbers here, right? The first one, the property management. A lot of times when you go into these assets, the units are under market rents. Why? The property management, they're on the tail end. They hear that the property is being sold. They're not the most aggressive in getting the market rents or top line rents at that point. $50 is a pretty negligible amount of the $1,000 rent these days. So it's usually easy low-hanging fruit to go ahead and bump that up. There's a variety of things that we can charge under the line item of other income to the tenants. A lot of us haven't lived in apartments these days, especially on higher end B class and A class properties. It's not just the rent you pay. There's always these add-ons. So it's just one of these things that the industry has moved towards squeezing the customer for more and more revenue at the end of the day. Obviously, it's things that they opt in for and choose, but this just one thing could lead to $54,000 a year of extra revenue. These properties are evaluated on a prevailing cap rate, a sort of equity multiplier, if you will. If you divide that by 5%, you just increase the value of the property by over $1 million. You're probably thinking, whoa, you see where this is going. So next thing, utility bill back to tenants. Say we bill some of the utilities back to the tenants, so they're burdening it. And when they start to pay it, magically the utility bills start to go down for the entire building, saving $40 per unit there, over 100 units. Huge bump in value. You've got the parking lot here. And in Texas, for example, you have a lot of hailstorms. So people will pay a premium for covered parking as opposed to standard parking, or they may pay more for better position parking. But let's say we started to charge $45 a month for just 100 spaces and created $4,500 a month. Now, we're not going to do this at every property. I think the bread and butter, especially for Class C and Class B properties, is just the real basic renovating the units. Of course, we don't try to kick tenants out. It's more naturally as it happens. Of course, I'm big on kicking out those really difficult tenants that nobody else in the community likes anyway. We improve the tenant profile over the years, and those people, we play a little hardball and we get them out by bumping the rents up a little bit more aggressively. That makes everybody feel good. Tenants, they don't want these shady characters in their community anyway. Just say you bumped up 5 units per month, right? You're going through the tenants normally anywhere from 5% to sometimes 10%, 15% is going in and out every month, especially in the summertime months. Again, we just let this naturally progress. Part of these multifamily value add strategies, you don't want your occupancy to plummet too much because you want to keep your cash flow. But that said, we've had it where occupancy has dropped 70%, even into the low 40s. Sometimes we've come back. It hurts cash flow in the short term, but in the long term, it actually helps the project. It's like ripping the Band-Aid off, as opposed to waiting half a year to get a good chunk of that tenant base out and in and renovate the units and new fresh tenants in there that are paying more. We're able to do that in a couple of months, right? Going through the math here, $4,500 a month times 12, you're creating about $9,000 at a 5 cap again. $900 at a 5 cap means $180,000 bump in value every single month. Multiply that by 12, you're seeing almost a couple $1,000,000 right there. And you do that over a couple of years. This one is more showing you the bump of value every month because we're renovating a handful of units. This is where the big value is coming. And now you're seeing, especially if you're coming from the house flipper world, this is really cool because this is long-term sustainable. I don't have to flip a house every single month. The cool thing is you've got all the other units online and hopefully you're in a long-term note and you have revenue coming in. Whereas a house flip, you could probably bump the value of that property by 6 figures, but you have absolutely no revenue. Until you sell that asset, you don't make any money. And you can get caught in that type of situation. Whereas here, the asset is cash flowing and going, and you're just continually to work at it, as these chaps here in this image are doing, slowly and surely. So here's some of these pictures. This was one of our early projects in Iowa, 52 unit. You can see the yellow appliances, and yeah, we still run into these from time to time. This is more from going from a C class to a B class upgrade. It looks nice, right? But you look closely, the sinks aren't nothing special. The cabinets are actually the same cabinets, just repainted with more modern hardware. And the appliances aren't stainless steel. They're just the standard black or white appliances. Here are the bathrooms. You can see the flooring. That's the big game changer these last couple of decades. This LVT flooring looks nice. Everybody likes it. It's cheap and it's pretty indestructible. Here's the bathroom. One thing that goes back and forth, and even in the same property, our contractor team and handyman team, what we do with the showers, sometimes it's just a basic resurface where you come up over the old tiles and you put that flat sheet over the top. Sometimes they just repaint the tub. Again, trying to do things the cheapest way to get the biggest bump in rents. Aesthetically, it looks pleasing. It's pretty durable, but it's not a kitchen or bathroom remodel that you're doing at your home that's going to cost 50, 100 grand. Again, we're normally in like the $5,000, $10,000 range in kind of the lower price markets. In Phoenix, you've got a little bit more California type of pricing that might get over $10,000, $15,000 per unit. Just things are a little bit more expensive out there. Manpower's a little more expensive. But going back to myself, from 2009 to 2015, I was buying the little rental properties. And I think it's a great strategy at the time. Now, that said, modern day now, you can't pick up properties for $90,000 that'll rent for $1,000 a month as I did. On the side note, it makes me a little sad. Like our kids can't just blindly buy a little rental property and do the buy, hope, and pray model. They could not get as much leverage, but I was buying with full leverage. Anybody can just pay down their mortgage and cash flow. One of the biggest mistakes that landlords make, as we talked about in the other module, is that whole discussion about return on equity, ROE. If you have a paid off property, yeah, dude, you better be cash flowing on that. But your return on equity is probably going to be in the single digits at that point. You need to get that thing moving and leveraging into other assets so you can grow your net worth over time. But if your net worth is over $5 million, you don't got to listen to a thing I say here, right? So it's all subjective at which floor of the wealth elevator that you are in. But if you're in the basement, first floor, second floor, you got to keep taking the equity in your house or other assets and get it working. Either sell it, go and buy more rental properties. Some of you might be looking to sell some of your rental properties and getting out of rental property ownership for the liability reasons. Another masterclass I've got is the 8 ways to offset capital gains when you do sell one of these properties, which is a good problem to have, right? Because you made a good amount of money on it. take a look at that in the e-course masterclass section. Just reach out to our team at thewealthelevator.com. This is the slow grind. It's not the get rich quick scheme. As you start to build assets, your monthly savings keep going up, and you can use that to buy more properties. But this is where I reached a problem with my 11 rental properties back in 2015. I had professional property management to deal with my problems and be the direct line of communication and enforcement with my tenants. But with a few $100s per property times 11, that was a few grand per month. Now, I was in my late 20s at this time. Most of our clients today need passive cash flow every single month. It's just that you need more properties than 11. But just to give you an idea what owning 11 properties feels like, I had an eviction or two every single year. And I had some type of big catastrophe, like tree falling on the house, some type of big storm that created a flood in the basement. There was a fire. What got me a lot of times is like there was some kind of domestic violence thing and somebody broke the window, and they say that somebody came through and broke the window from the outside, which we all know it really happened. Things happen and I got to pay for stuff and more probably deal with it, right? The property manager, managing the manager, keeping them accountable, because residential property managers really aren't the greatest out there. And especially when they know that you live in California or not in their backyard, they just associate you with some rich, absent landlord. And now you start to see these ridiculous repair bills for the simplest of things. I think I almost fell off my chair when I saw a plumbing repair for $900 where we knew it was just simply clogged. I don't know why you got to send two guys for that too. But with 11 rental properties, these evictions piled up. They're going to happen. And I had decent rental properties in okay areas. So it was not like I was in the slums or anything like that. Over several years, I had probably about 12 evictions. With those 12 evictions, one out of every three turned out to be a big catastrophe, like this video here. You can see by the thumbnail how bad it was. And at the end of the day, I think it costed like $20,000 to repair this thing and get the property back online. And then you're thinking, wait a minute, like, are we doing this in the first place? I thought we're trying to make money, because that big of a repair bill is like years of the supposed cash flow you're supposed to get from the property. Obviously, when you buy rental properties, you have your CapEx line to account for this stuff somewhat, but that just blew that budget out of the water. Now, for you non-accredited investors, I'm thinking you have to go down this route, unfortunately. And I think this is also a cool route for a lot of our kids to go through. We talk at our retreats about buying little rental properties for our kids so they understand this business and they understand about the ups and downs of life. Even if you didn't deserve it, you're just the innocent landlord and you have to deal with this nonsense. Sure, you lose a little bit of faith in humanity by interacting with these types of things, but I think it's a valuable skill for our kids, because unfortunately, they're never going to have to feel what it feels like to be going through these initial adolescent stages of being an investor. But most of you guys out there are accredited investors and are skipping over rental property ownership. But that's where, from one point, if you have 11 rental properties, that's some type of eviction every quarter, some kind of big catastrophe every month, but that's with 11 properties. Now, if you have 30 properties, you really need to hit those cash flow numbers to retire. Now you're talking about an eviction every other month. A big issue comes up almost every other week. And that's where this is not scalable. This also puts you on the front line of liability. When something stupid happens, like they fall and twist their knee, they sue you directly. Whereas in a syndication as an LP investor, you are an LP. That's the beauty of a limited partnership. There's limited liability for you. It's no different than you owning a stock in a company. A lot of these kids out there like to do what's called the BRRRR strategy. They buy something, rent, rehab it. You can make a lot of money doing this, but boy, is it a lot of work and more importantly, a lot of risk, right? And I think that's where you have to ask yourself, if you have construction background, project management skills, and the connections to do this remotely. It's extremely hard to make the numbers work in a high price area where a lot of you live. So you've got to likely do this remotely. Some people do this in Kansas City or Alabama, where they know nobody. And contractors know that you're just some out of state sucker. And they call them contractors, highlighting the word con for a reason. And if you've also heard the term change orders, it's hard to keep these guys accountable because things just pop up and your budget increases. And after a certain point, you're not making any money. You're losing money. I think that's the difference in terms of liability and exposure by going down that BRRRR route. And everything all looks cool when people talk about the success stories, but you never hear about the failures. At the end of the day, it's just trading time for money too. I've always been like, you don't want to put more than 5 to 10% of your net worth into any project. Doing this buy, rent, rehab, rent, repeat strategy, you're putting a lot of concentrated part of your net worth into this. And speaking to the accredited investors out there, that's why the syndications and private placements line up to be a lot better for you on the second floor of the wealth elevator. But if you're a non-accredited investor in the basement floor or the first floor, you may have to do things like this. There's a lot of internet gurus. Be careful who you listen to. A lot of these guys are just making money teaching people how to do this because it's too damn risky to do it themselves. And it's funny, a lot of these guys, I think they're smart. Like they make like they're flipping houses and they're on Instagram. Of course, they're on Instagram, right? And TikTok. These are for the younger guys. But they make like they're flipping these houses themselves. But in reality, they're just marketing for suckers who think that they want to flip houses that are newbies that get involved with this and need money to the hard money loan to go buy the asset and do the construction on it, take on all the risk. And they're just playing a middleman to a hard money lender out there, a bank or a debt fund who lends 50 grand, $500,000 to this investor. And these influencers out there are just making a point or two on the transaction. But they tell everybody, oh yeah, I was involved in another flip where they just was the lender on it. That's out there. Be careful of that. It's not always what it seems. We actually are the ones doing the deals in the trenches, operating, but certainly putting our name on the documents as the sponsor. Many times I'm actually the one personally signing on the debt. So yeah, that's a lot of skin in the game. The nice thing about these syndications and private placements, you got to read your PPM docs, right? But you're more on the equity side where you're involved in a house flip as a private money lender, you're just the debt investor. If the property knocks it out of the park and makes a whole bunch of money, you don't really get any of that. This is why I like the spirit of these syndications and private placements, because there's a split structure. Everybody's incentivized, especially general partners, to do what's right for the assets so that we all make money. The GP can make money and you as the LP get alongside of that. At the end of the day, now some people maybe not agree with me, but I think it's structured in a way where it's a great harmonious joint venture. But if you own rental properties now, just do the math, folks, right? Like with $300 per property, you're going to need 20 to 40 of these things to replace your income. You run the risk of a $10,000, $20,000 setback every third eviction, at least in taking my track record into effect. The big thing here is the liability, and then the debt is in your own name. Whereas in syndications, the debt goes in the key principals' names within the general partnership. The passive investors are not recourse on the debt. It doesn't even show up on your credit record. You guys are not on there. You're just passive investors. And the last thing I'll point out here before I close this out, I think some people, what they like to do is they like to pay off these properties. They call this the domino effect, which is great. But the problem with that is with single family homes, there's this tidal wave of CapEx. At some point, huge things start to go. It's like health and bodies, right? When you get to be 40, 50, 60, things just go. Organs start to fail. Things pop up, just like houses. So the idea is you never really want to be in an asset for very long. What's long? I would say 5 years to 15 years or less. You're going to get hit with what I call the CapEx tidal wave, where it's going to catch up with you. And then it's just going to be eating into your profits. This is why on our side, what we try to do is we get into an asset, we rip and roar, we do the force appreciation, and we get out. These assets only have a certain serviceable amount of life. anywhere from 50 years to 100 years. Certainly at a certain point, 50 years down the road, it becomes more of a Class C asset. And now you start to attract more seedier tenants. This is why you look at Las Vegas, right? The Strip, you start to see assets like the Circus, which should have got removed a long time ago, in my opinion. They get bulldozed and you put up a new asset. This is just what happens in real estate. Things get refreshed. But here's a vision, right? And this is, I think, it also illustrates on the left side the bifurcation between you and your peers out there. Now, I'm not saying you need new friends, but I think what's difficult, what a lot of our folks, what at least echoing what they say and why they like our family office Ohana mastermind so much, they can talk openly about their finances. For a lot of people, especially myself, money is the big thing. I love money, the journey, the growing it. In our community, we can talk about money without comparing sizes with each other. Most people will talk about sex with their guy friend, girlfriend, before they talk about their family's finances. It's just a taboo subject out there. Here, obviously, it's a different culture and we try to keep it responsible. We're not trying to showboat. You're seeing where, I like money because I think it guides family values and where you're heading to. You may never want to build your own philanthropic organization, but money magnifies people, who they are. You're seeing this stark contrast between how normal people live out there, just struggling to get by with no assets, and then just starting to build your portfolio of all these private placements and holdings. And obviously how it results in just increased cash flow at the end of the day. So how do we get involved in these types of things? How do you transition from the first floor to the second floor of the wealth elevator, as I personally did when I started to sell off my little rental properties? I don't have any little rental properties because they're just a pain in 2015 and beyond. So if you're new to this, what is investing in syndication? And since syndication is essentially just a method of pulling together passive investors so that operators, general partners, sponsors can go after a stronger deal with a very little low competition. And to speak to that competition, when you're buying properties under $1 million, even under $5-10 million, it's extremely competitive because of access. You're fighting with the average person, but within our world, right? People buying rental properties. And at this point, you're able to fly higher than these mom and pop investors and get in more institutional investments. Now, obviously, we try to stay right below the altitude of the institutional players who are investing lazy stock market money in the form of REITs. The REITs will buy these types of institutional assets, but the reason why we don't like them is because there's layers and layers of middlemen and extra fees, right? And that's the thing about these syndication deals. You're investing directly with the operator. Now, there's these crowdfunding websites out there, but the crowdfunding websites is just a middleman. They're just a broker dealer. And also, they don't really have any skin in the game if the deal goes good or bad. And I think that's what's different with us. We're the ones actually flying the plane and like the sponsor in the deal. And also the whole idea is like the plane goes down, all the LPs go down, but hey, we're in the cockpit too. We're going down also with everybody. None of this grab a parachute, get out. If we don't do that, I think that kind of speaks to the honor code in all of this, at least that we try to uphold. A lot of pros of being in syndication deals, the passive income, not ordinary income, the difference between ordinary income and passive income, and how you can use passive losses to offset passive income. Also, cool strategy, real estate professional status to offset all ordinary income. We'll get more into that into the next masterclass. Number 2, you get to piggyback on the experience and more importantly, the deal flow of the general partnership. When we first got it started, we had to introduce ourselves to brokers. Nobody knew who we were. But by 2020, when we went over $1 billion of assets under ownership, the brokers knew us by first name and brought us the best deals. They knew we were proven players in the industry. This also expands as we look outside of real estate asset class and multifamily. It's all about who you know. And I've met people all kinds of ways. I'm a part of a bunch of masterminds with other business owners. I've got partners, and it's all about the personal relationships. This is where I think I've been blessed to have all this. If I didn't start this podcast back in 2016, I wouldn't have met all you guys. I wouldn't have created this platform. And it's that platform that now gives me notoriety. It makes me like cool kid in high school in a way. I was reluctant to be in that position when I first started to do this back in 2016 to 2018. But I certainly understand the power of this magnet. Not only does it attract passive investors, it allows me to create a community in the family office Ohana mastermind and hui these deals together with passive investors. What a lot of times you don't see is how it attracts strong operators. A lot of the operators we get connected with these days are connections that we've partnered with on a general partnership level, and they have connections and they refer us to their buddy. Even though they have no skin in the game, they don't get any kickback from them. It's just what we do on the general partnership level. We try to cordially help each other out, and we're able to figure out just through the grapevine who's good. And reputation is a big thing. We just had a meeting with one of these guys the other day, and the meeting started out with, we've heard of the wealth elevator guys before, right? Our reputation precedes us. We do what we say we're going to do, and we're cool to work with. They like to work with myself and my team. Also, number 3 here, professional commercial property management. Residential property managers are just glorified real estate agents. A lot of times, unfortunately, the real estate agents who can't sell houses, property managers is a bit of an entry-level job. When you start to get into commercial assets, one leg up they have is all their units are in the same area. When you get 50 units or greater, you can have somebody physically there all the time at the property, which further creates the community at the property. New tenants are coming in. It's all a part of the sales process to getting new tenants at higher rates. That commercial property management company have a lot better systems to manage the asset that's in front of them. Number 4, better professional and better bonded vendors. You just step up hugely. When I was buying single family homes and when we used to teach people how to buy little rental properties, was one little tip would be try and find the local HVAC vendor who on the weekends, not under their company, fixes your HVAC, right? You get the personal cell phone of the guy and he goes in there and fix it for a lot cheaper. These are the scrappy things you do when you're a small time landlord. And then if you're on the basement level, first level of the wealth elevator floor, check out that remote rental e-course for all you accredited investors. I wouldn't even bother with that. You guys are moving more into the syndication world. The starting point would be that syndication LP due diligence course. When you're in commercial assets, you're working with better contractors. They might be a tad bit expensive, but we have the money to pay for top level talent. Number 5, better debt options. These are amortized over 30 to 35 years. In commercial real estate, the terms are a little bit shorter. You try to go for the longer terms. 5 years to 15 years is the range that you can get for agency, non-recourse debt, Freddie loans. Sometimes certain deals line up. If it's a quick flip deal that you do in less than a few years, you get a 2-3 year bridge note and then either sell at that point or go into a more perm financing, 8 to 15 years at that point. But a lot of these terms are better in terms of interest only is pretty typical for several years. Non-recourse debt is key. Non-recourse debt means that if anything happens, the bank doesn't come after if there's any extra balance. This is the opposite of like your guys' home loans when you buy rental properties on your own. That is recourse debt. If you buy a property for $1 million and it sells for $500,000 and there's a $700,000 note, you owe the bank $200,000 in a recourse loan. But in a non-recourse loan, in theory, you could just walk away from the asset. Maybe that doesn't pertain to past investors because you're another step removed from this anyway. You're not even a loan guarantor. But I think it just speaks towards the reason why they give this non-recourse debt to these assets, because these assets pencil. And it's something that the bank feels comfortable enough to give these nice loans to. And this is where I was like, this is one thing like back in 2016, I was like, why the heck are all these government subsidized loans that are non-recourse going to these wealthy people buying all these big apartments and commercial assets? Number one, that's the way that the government stimulates money to their need of lower middle class workforce housing. The government has tried to do projects where there's low income housing authority projects. I think we all know that's a failure and not a desirable way to go about things because you just create ghettos or cesspools of drugs, etc. When you start to do that, the government has realized that it's best practice to scatter the lower middle class out in the communities. You may obviously not like this because it's not in my backyard stuff, because a lot of us live in some of these areas and we don't like that little bit lower class property next to them. I'm just talking in terms of what the government, what the modern practices are. So it's not like they can go and buy these properties out there infill style. They subsidize a lot of these loans for these syndicators and people like us to take advantage of to go out in the community and buy these assets. When you're investing, you always look for what are the free money out there from the government. Not necessarily you take it, but you try and align yourself in that position. This is one way that we've been able to take advantage of what is out there. And I don't really see this going away. Another one in terms of the loan debt is not in your name. The GPs are the loan guarantors, and it creates a situation where there's additional skin in the game for them. And number 6, stronger legal protection as a passive investor. We've had murders on properties, fires, domestic violence. We've unfortunately had people slip, trip, fall. Had a guy that was sleeping and the ceiling crashed and he wanted to sue us because he got hurt on the floor. I don't know why he was doing, but you have the craziest things happen. This is crazy. But LPs never hear any of this because you're LP, of course. Number 7, you get better tax benefits due to cost segregations. When you're buying a rental property on your own, you're probably depreciating it over 27 years. With current cost segregation laws, you're able to aggressively itemize the components of the building and take some of those off in the first year. So in some cases, we're able to get 1/3 of the depreciation all in the first year, which is almost 10 times as much that first year. We're going to talk about how to use this personally on your taxes in a future masterclass section. These are all the things I went through back in 2015 and 16, saying, not only am I going to listen to the advice of people who are higher net worth at myself at the time, but these are the things that I was tabulating in my head and pros and cons. I got to sell these single family homes and smarten up to what the accredited investors are doing. And then lastly here, larger institutional assets providing more stability and more economies of scale. When you buy these types of properties, the banks are giving you a commercial loan. The commercial loan is underwriting the asset to perform at a certain rate. Whereas when you're buying a little rental property on your own, they're underwriting it more as a residential property that you're living in. So they don't necessarily think that you can run it as a profitable rental. Sure, you can pay down the loan and anybody can cash flow and profit at that point. But again, what we're trying to do is walk that fine line between a good amount of leverage so we can produce the returns that investors want to see. Nobody wants to just make 10% in an investment. The expectations are higher than that. And therefore, you have to ratchet up the leverage. And luckily in real estate, you get good leverage options as we discuss. I would say the one big con is the counterparty risk. This is the idea that people are nefarious out there. When I first started to get into this industry, I was pretty well networked. Back then, I was able to travel and I wasn't married. I didn't have kids. So I had a lot of time to travel different Texas, California, all over the place to all these conferences. Unfortunately, all these conferences that you see online are just put on by gurus, real estate club type of events with a lot of young people trying to get rich quick, trying to be general partners starting out. You meet a lot of bad operators under $1 billion assets under ownership. In some cases, they're incompetent and dishonest. What I try to find these days are operators that are competent and honorable. Unfortunately, you don't really find that out until you get into bed with people. What I try to do is test it out myself, work with people I have long relationships with. My first 15 deals I invested with right out the gate, Come to find out several years later, even 5 years later, 3 of those 15 turned out to be not the best people. And that's why we say, if you're going to invest more than $250,000 into this game, could mean 3, 4, 5 deals. If you're finding lower minimum deals, 50 grand out of that 250 could be up for risks if you go off of my beginning track record on stepping on landmines out there. The idea of some people have it in their mind that they want to control everything, sure. And then obviously that violates the having huge chunks of their net worth into any one asset, which is a big risk exposure. If you can put your ego aside from being the guy, I don't know why you want to be the guy. To me, you just want money so you and your family can live a good life. You grasp onto this concept of having a little of many watermelons as opposed to all of the grape is a lot more fruit at the end of the day. And also it's fun, right? We've got the community where you come in initially looking for deals. You want to find a CPA. If you guys need those vendors, just reach out to us. We can help you get started with that. But I think if you join our family office, Ohana Mastermind, it's more about the social relationships at the end of the day, right? Finding people aligned on that path long term. Once you hit $2 million net worth, you start to realize life's not about saving your money and gamifying your financing. It's more about social relationships are the currency of the wealthy. Now, if you don't believe that, we're probably not the group for you, or you probably need to make some more money and get your net worth over $2 million, and then we'll talk. If I'm just foreshadowing and sharing my own experiences, I was extremely cheap. I don't know if selfish is the word, but some people are just really tight and they're not fun to hang out with. They got money, but from a social currency type perspective, they're very poor. And it's very hard to meet friends after 30s, 40s. We're all going to get financially free. You invest in the stock market. A lot of you guys are good savers. You're going to get to $1.5 million, $2 million pretty easily, a little bit before normal retirement age. We're all going to get there, right? I'm here to help expedite things because time is the most important thing. But you're going to realize your goals are going to switch from money, saving to experiences and relationships. This is what we try to do with these projects, whether it's a multifamily value add where you're just trying to bump the NOI by 10 to 20%, enough to double your money, or a development where you build something from scratch. That's an obvious form of a higher level value add, force appreciation, or you're buying up 3 CPA firms, improving the management, synergizing the expenses, sharing the client lists, and then bundling up with 4 other CPA firms that you bought and selling it for a higher multiple. These are all forms of value adding, force appreciating businesses, whether real estate asset class or non-real estate asset class. From a return on equity standpoint, you're going in, force appreciating the asset, and in the beginning, you're making a good amount of money. Over the years, this dwindles down. This is the biggest mistake landlords make, where they continually pay down their mortgage. The property appreciates over time. And when you look at the deployable equity in relationship to how much money they're making, their return on equity is just going down into the single digits. Now, people ask, when do I re-leverage into the next deal? Sell this one and buy 3 others or go into the next deal? That's usually around a little bit more than 10%, double digits. And it's all up to deal flow. And deal flow is dictated by your community and your people around you. Family offices get very good deals because they're plugged in. I think that's where we are, right? We're well connected. We can find good deals. And for those people, they may sell assets once their ROE goes down under 20%. If you're like a very unconnected person, very lazy, now you see why some people, it's smart for them to pay down their mortgage in the single digits here. But this is where, if you understand this area under the curve concept, which is the way you improve your net worth, you need to cycle in and out of deals. And this is where the syndication model, the private equity model, where you're going in, you're doing what you can. And yeah, it might take a year, might take 5 years or more, but you're going into a variety of projects. And this is naturally happening over time. Now, another cool thing about these syndications of private placements, it can be either in a fund model or a single asset deal model or SPV, special purpose vehicle. A pool fund is a bunch of assets as opposed to an individual deal. Like, for example, we're going to invest in this 200 unit apartment complex. We're going to value add the units $10,000 per unit and rip and roar for 200 units. A blind pool is where future assets investments are unknown. There can be a prospectus on the fund saying that we're only going to buy 3 assets or under $20 million of assets, or it can be completely obscure. There's pros and cons for both. We've talked about this in the syndication e-course more in length, but just know that this is out there. Most investors who are new, I think funds are better because you get instant diversification. When you're in less than a dozen deals, you don't really have diversification. So that's why I'm like, guys, get started now investing. The only way you're going to learn is by doing. And the only way you're going to grow community is by having street credibility and deals already. So you have something tangible to talk with. Nobody wants to interact or build a relationship with somebody who's just doing the syndication course. That person is obviously a waste of time to interact with. I'm here to help, but I'm just saying from a perspective of another accredited investor who may want to build a lifelong connection with you, an organic relationship. Most investors, what I see, the 5S, a lot of you guys like to feel, touch, know what you're investing in. And whether it's like you want to invest in a certain market, 5 deals in Texas, 3 in Arizona, 7 in Florida, or you want to have 5 multifamilies, 1 self-storage, 6 private equity deals. Like that allows you to customize your portfolio. People ask me all the time, what's a good portfolio allocation mix? And I'm like, dude, we have gone so far off of the standard Vanguard Fidelity. Here's what you probably should have when you're age 56, right? We have gone so far off that path. And this is why it's critical for you to get around other purely passive accredited investors so that you can grow that organic relationship, so they can open up that kimono and show you really what's on the inside. I mean, it's rare when people actually sit down with their computers and show people their pie charts, because that is getting a little bit intrusive. You grow the relationship over time. That stuff does happen, I think, with individuals in the community. But here's a little bit of deal structure. A lot of these syndicated deals get wrapped up in a legal structure where you trigger securities laws. The general partner operator needs to have a lot of, we pay the lawyer like $15,000, $20,000 every time we do one of these deals to do all the documents the right way. There's a private placement, or PPM for short. It does a couple of things. It protects passive investors, that the general partners have fiduciary responsibility, not lie, cheat, steal, etc. And it also protects the general partner to prevent disgruntled investors from suing should the investment performance not meet what was said. There's always risk in investments. Performas are just performas. They don't really mean anything at the end of the day. The general partner wants to make passive investors happy so that they come back as reoccurring customers. But we live in a litigious society. What's to stop an investor from, say, a deal was trying to double your money in 5 years, and in year 4, you got 80% of returns. So great return. But what's to stop a passive investor from suing, saying, you said I was going to get 100%. Obviously, that's ridiculous. But hey, that's the world we live in. But this is the evolution of, at least speaking for myself, a lot of us are first generation multimillionaires. So we started off with almost nothing. A lot of us had good paying jobs or businesses, and we worked hard in our 20s and 30s. People out there who already have substantial net worth probably bought a rental property or 2 or bought assets in their 20s. It was funny. The other day, my spouse, she understands this stuff to some extent, and at least deal with my rants from time to time. But we're talking about some investors out there who had $4 or $5 million net worth already in their 40s. And I always tell her, I've talked to thousands of investors, and you guys always do those onboarding calls. So thousands of data points. I already know what your net worth is for the most part. Once I get to know you a little bit with limited data, what your AGI is, what do you do for work? Have you owned a rental property? Nothing really surprises me anymore. The only times it surprises me is if you're a trust fund kid and your parents started you off with a few rental properties, then your net worth is probably 5, 7 million in age 40 or 50. But for the most part, vast majority of our investors are first generation multimillionaires, the generation that started the legacy financially. But I was telling her, it's like that Monopoly game. What do you do in the first times around the Monopoly board? You just buy stuff. And she's, you just buy anything? I'm like, yeah, seriously, you just buy anything. Doesn't matter if it's Park Place or that crappy Baltic Avenue. You just buy stuff because more times than not, it's good. And that's like me. Like my first few properties were in Seattle, not a good market to invest in for cash flow, maybe for appreciation. I wasn't sophisticated in terms of knowing what rent to value ratios were or running a P&L and knowing if I'm going to cash flow anything, but just got started at that point, just buying stuff. And I think this applies for even people in their 40s and 50s who get started with us, who may already have $1 million, $2 million. The syndicated deals that we sponsor, we go through a lot of deals and we pass on most of the stuff. And unless things align with good vibe and understanding with the deal and the people involved, we don't move forward. We're in this deal along with you guys. Sure, you guys have to do your own due diligence, but we've been in the game for a while. I would say we're not a huge institution, but we're not one of the smaller guys just getting started under $1 billion of assets at this point. I like to think of us as more middle market operators. Speaking for myself as an ideal client, what do I want? I want to invest with people I know and trust who have been doing this for some times. They've seen some ups. They've had some black eyes, some lessons learned, and especially going through the 2021, 2022 market cycle. People I could trust at the end of the day. That's all I really want. And we get along too, right? We see eye to eye. Yeah. So that's at least what the community, the business I wanted to create with as a boutique syndication company. Now, well over $2 billion in assets, we are popping up to be a bigger institution, which is why I had to expand my team. It's allowed me to expand our reach in terms of general partnership, operator relationships to find better deals for you. This is all that transition for you guys, probably in this TWE 2.0, going from might have had rental properties, but certainly getting more into syndications and private placements. And where I want to take everybody is into the 8-figure range. Get over that $5-10 billion mark. Most end game I define as $4 to $5 million net worth, because at that point you can just put it in T-bills or life insurance and live the rest of your life. But after you're doing that for a little bit, you start to realize that, yeah, I can get to $10 million net worth. And at that point, once you get to that 8-figure mark, it's a substantial number where you're implementing master dynasty trusts, irrevocable trusts, and giving something big to your children for them to take it to the next level. And family offices, which are somewhat defined as $100 million net worth families and above, they're not created overnight, especially if you don't have some type of concentrated business. It's going to take several generations to get to that level. But it all starts here, and it all starts with this network. You're not going to just play golf. You're going to need to try and find some type of passion, or at least just keep building, keep growing. I think that's what's cool about gardening. It's a constant growing and seeing where you can get, but also having fun along the way and not stressing out about it, which I think a lot of us were in the TWE 0 and 1.0 stages, and probably even now at the second, third floor of the wealth elevator. So counterparty risks, where does this all break down? Investing with the wrong people. Golden rule here that I tell a lot of people in our family office, Ohana, over 100 people in there, they show me deals like, what do you think of this deal? And I always start off with saying, like, who do you know personally, or have you invested with this individual in the past to verify track record and experience? If you've heard my story, it's at thewealthelevator.com/fail. I had a blog article where I talked about the first time I invested in syndication back in 2012, and I lost all my money. More times than not, especially in my first 15 deals, it went well, but I got caught 3 out of those 15 times. That's why you need a community around you. When I first got it started off, and most of you guys starting off your first several years, you're not going to have a robust community of passive investors out there to have a Rolodex of who to invest with. So you're like this guy running across the landmine field, just hoping you don't get your head blown off or a limb blown off, to use a better term, because you never want to be investing with your entire net worth, something you can't lose. So I invested with this individual, and how would I find them? I was just talking to one of these self-directed IRA companies, and they recommended them. What probably happened is there was some type of kickback system, which is how all these forums out there, these so-called investment groups out there work. It's just a cesspool of like people paying them behind the scenes to promote their brand. And if there's internet forums out there, it's just like a bunch of fake reviews out there for them. And then they like to put fake reviews, bad fake reviews on the other people. The same game that you have like with the Amazon reviews, if you're an e-commerce business owner. But yeah, I invested with these guys and the deal went belly up. I think they actually stole the money. But the guy who referred me over, he probably got a kickback or maybe just had beers with him the night before at the conference and he just was the top of mind. The guy was just a sales guy who referred me over of a separate company. Again, no experience. The guy probably was in his 30s or 40s, pretty young. He was not an investor himself. So the golden rule here is only take referrals from people you have a real organic relationship. None of this, I had a beer with somebody and thought we were cool. So I listened to who he was investing with. No, you need to go deeper. And that dude needs to actually have invested with these people in the past. That's the gold standard. It's not going to be possible for you. It wasn't possible for me when I first started, right? I had to just go on a whim, but it's going to take you a few years to get plugged in to start to establish that so you minimize this chance. But some quick tips if a syndication is legit, learn how to do the numbers yourself. That's what's in the syndication e-course. You don't need to go to the entire thing. Focus on, if you're short on time, just go to that numbers section to understand about reversion cap rate, what is good assumptions to be looking for in the deal so you can underwrite the deal. Because as a passive investor, you're never going to be given the rent rolls, the P&Ls to be able to do that due diligence. That's what we do on our side. Speaking operator to operator, as sophisticated investors, we are able to run it through our own model with raw data, where that's not really in the scope of a passive investor. You'll want to work with a good operator, but it's hard to verify that because you don't know if anybody's telling the truth these days. We've been audited by regulators. We were able to show the documents that, yeah, this is what we've done in the past. Most times people under a couple $1 billion of assets never really get roughed up by the regulators and they can just put whatever on a track record sheet, an email, or their own website. One thing that I did when I first getting started was work with my legal team to verify people. This jump-started my relationships in the ecosystem. Your network is your net worth. It's not what you know, it's who you know. If you are looking to be more serious about investing six-figure numbers into this world, I suggest joining our family office Ohana Mastermind. You guys can apply at thewealthelevator.com/club. We do have sparing events from time to time, which we do allow you guys to test drive the group, but you can't come to those again and again. That is for you to come once, meet myself, meet the culture, meet the community, see if the Ohana Mastermind is for you. The events are mainly for family office members. I try to have people see the community at least once. In 2015, up until that point, I had done everything by myself. I thought I knew everything. Obviously, I didn't. I was just that dude buying rental properties as we started at the top. Obviously, not a good long-term strategy. If I didn't interact with a handful of cool accredited investor dudes that informally mentored me, I would have never learned the strategies that we talk about today: alternative investments, tax strategies, accredited investor banking, that whole trifecta I keep talking about. I would have never pieced this together, which I put in this nice curriculum for you guys. And I've had a lot of fun since stepping out of my introverted self back in 2015 and meeting all these people. And it is a little bit out of your comfort zone. I get it. Most of the people in our community are hardworking introverts that put their head down. But you have to realize, or at least understand, that a lot of the high net worth second, third generation, they understand this game, that it's a people game. And they're good bullshitters. They interact with people good. That's at least my takeaway from interacting with those types of people. And those are the social skills, which I think are going to be harder and harder to come by with those Gen Zers out there. That is going to be even more important. But again, like, this is the whole Dunning-Kruger effect, right? At least speaking for myself, when I first started, I thought I knew everything, right? I was the best. I didn't know anybody, so I was technically the best. But then you go to this transformation where you start to meet other people. It's like, wow, there's more to this than I thought. And then you start to get to the stage of, I know that I don't know a lot about this. And that's when I think the learning starts. And that's what at least happened for me. And then you start to get ingrained and you start to know what questions to ask. And then you start to get more comfortable in about a year or two, you start to really get traction. This happens mainly when you join a group like our family office, Ohana, and start to get ingrained and meeting other people and building those one-on-one relationships. We will talk about this more in the syndication LPE course, but we talked a lot about multifamily real estate. It's a good starting place to have your first half a dozen investments come out of there. What people discover is that there's a whole bunch of these other investments out there that make a lot of sense, right? Why would you ever want to invest in traditional investments where there's a lot of these middlemen and you don't know what you're really investing in? You're just investing in the top 6 companies in the S&P 500 effectively. The weighted average is heavily those top 6 companies, which is mostly in tech these days. You start to see all these types of investments that are aligned with lower middle class America. The need is not going to be going away and maybe in fact increasing over the long term. We're going to be talking more about this in the syndication LPE course, but I just wanted to touch upon it that traditional investments is the stock market, bonds, a lot of the more marketable securities, stuff that financial planners sell and make a commission off of, where alternatives is, multifamily apartments and then all this stuff here. And then now you're getting into private equity, buying businesses, which is the huge opportunity going in the future as all these baby boomer business operators don't have succession plans and need to sell. But this is all part of the wealth elevator framework. Most of you are in the second floor of the wealth elevator, needing to diversify into a lot of projects in the syndication and private placement world. If that's you, the next step is to get into that syndication LP e-course, go through that, and then start investing. I follow the 70-20-10 rule. 70% of it is actually doing it. And in this case, investing, getting skin in the game. I'm not a huge fan of crypto. I don't really invest in it myself, but I invested like 10 grand a few years back because I know how I work. I put skin in the game and now I watch it. Maybe that was a similar effect with fantasy football, right? You put some skin in the game and you start to learn all the players' name for some strange reason. Going back to the 70-20-10 rule, 20% of this is community, learning from others. And only 10% of it is the academic stuff, which is what I put out in the e-course, my Wealth Elevator book. All too often, people spend way too much time with the 10%. Follow the 70-20-10 framework and get more involved into actually doing it, investing it, rubbing physical shoulders with people in our community. That's the only way you're going to make progress. Sure, there's some pitfalls out there as I encountered when I first started to invest. That over time, you got to push through that infancy, adolescent stage, or align yourself with us and follow us into the projects that we sponsor. This has absolutely changed my life for the better. And it's what I want to have people go down the same path. But obviously, this is not for everybody. Who would get our coffee? Who would build our bridges? Who would be our dentist? Who would be our doctor? Who would do the great things for our society? And who would pay the most taxes too, right? We'll see you in the next module.